I think it's largely a technical rebound and pullback. If you look at the GDP figures we had out last week, the euro area economy shrank by 15% in the first half of the year, and that coincided with extraordinarily weak PMIs that we got out in March and April. And in effect, what's been happening since April and May is that economies have been easing lockdowns, and that has led to a revival in economic activity as businesses have been, a greater number of businesses have been allowed to start to resume something, at least trying to return to normal. And that sort of switching back on of these economies has clearly led to growth rates going from being extraordinarily negative in the second quarter of this year towards, I think, what's likely to be some quite impressively strong growth rates as we get through the third quarter, and momentum continues to build. So I wouldn't be surprised if we continue to see a further big improvement in these PMI surveys over the next couple of months, probably reaching a peak in September or so, which is I think likely to be when the fastest pace of this technical rebound is underway. After that, I think things are likely to get a bit more challenging.
Even though we are seeing this rebound come through, and as you said, we should expect it to continue when we look at these numbers, within the headline, we're still seeing some pretty substantial weakness in the labor market. The chief economist over at IHS Markit, which puts together these indicators, said the jobs numbers remain a major concern in the euro area, especially as the labor market is likely to be a key determinant of the economy's recovery path. So this is a concern, and the final manufacturing employment PMI came in at 42.9. So how do you expect the employment picture to track the European recovery that we're seeing at a headline level?
Well, the interesting thing there is that the labour market has become completely detached from what we're seeing in the economy. Normally, if we'd had a recession on the scale that we've seen, we'd be expecting euro area unemployment rate to be, in the high teens, I'd have thought. And yet, you look at the unemployment data we've had out in the last couple of months, and unemployment's remained well below 10%. And that's, of course, thanks to the government furlough schemes that have prevented that big loss in labour demand that you see in the PMIs from translating into much higher unemployment. And it's that higher unemployment that would ultimately be the big economic headwind to any longer-term recovery once if and when the virus becomes less of a constraint. And there, I think, actually this speaks to the success of economic policy that's been rolled out across Europe in effectively preventing widespread job losses, widespread unemployment in response to those very low and understandably low PMI figures, because effectively what that just tells you is that businesses have been shifting their employees from their payroll onto the sort of public payroll through the furlough scheme with the promise, if economic activity does recover over the course of time, that those people can be re-employed properly back in the jobs they previously had.
And at this point, what's your take on whether that approach is going to serve Europe? The fact that many European countries have chosen to keep employees on companies' payrolls by subsidizing their wages versus in the U.S., where we've seen policymakers encourage companies to shed workers. They're paying expanded unemployment benefits, and then they can potentially shift sectors a little bit more easily. I mean, is it going to serve Europe, or is it going to hinder the recovery, do you think?
I think it's going to serve Europe. Europe has a much less flexible labour market, and one of the negative consequences of that is that generally when people are made unemployed, it takes a long time for them to re-find a job. So in effect, putting this insurance and safety net under the labour market is a good way of preventing that long-term unemployment from building up. I also think it's kind of effectively taking out an option on the possibility of the economy eventually returning to normal and allowing businesses that, if and when the virus does properly abate, to be able to sort of restart in a fairly functional way. It obviously means at this stage you don't get that clear out of the economy and potentially longer term businesses that perhaps after the virus will not be viable. The government's effectively subsidizing them during a period in which they can stay viable, but then will fail. So the cost here is ultimately higher government debt. But given that Germany and France can finance themselves at negative interest rates at the moment, and even countries like Italy can now borrow for 10 years at 1%, I think that's actually a sensible option for European governments to take out.